My focus at Day Trade to Win is to teach traders how to look at price action a little bit differently than other people introduce price action. As you can see, I really try to keep it as simple as possible. The reason why I started the webinar this morning a little bit earlier than I usually do, usually I start at about 10 o'clock, is because I want to actually show you the live orders that are going to appear on the chart. I have the Atlas Line software currently up, and so as soon as we have a signal for the Atlas Line, we're going to see it live, and I'll show you how it works, how it's supposed to be taken, how to manage it. So all the aspects of trading with price action using the Atlas Line, I'm going to review with you and go over as well. But besides that, I also want to show you what's happening right now in the market. Okay, because when you look at the market, you may think that we're in a big free fall, right? The market's going down, and a lot of people now are referring to the market may be ready for a correction. But I have a different take on it. So what I'm going to do here, I'm going to show you and do a little recap in case you guys have not seen the videos that I put out recently in January. I did a webinar for NinjaTrader. I did a webinar for our clients here. It's recorded as well on the blog if you want to see it, or on YouTube. And the goal here is to understand what the expectation is as you move forward through the day or through the year or through whatever time frame you're looking at. And because this year is a special year, I mentioned in the previous webinar that it's a super year, 2015. Hopefully you guys had an opportunity to see that video where I explained that every time the market pulls back and then continues higher, we have an opportunity to go long the market. And the reason for this is because the year 2015 happens to be a year that ends in a 5, and historically it's been very accurate that every year ending in a 5 has been an up year, has been a bullish, higher close than open year. So in knowing that, there's a little bit of a bias that dictates if you're going to take a trade and you're looking for the best trades, let's try to go long when it makes sense. And so when I look at the market, I try to understand, is it the right time to go long? Because timing is everything. Hey, Jared, Jeff, Will, all the guys here coming in, guys and gals. And so when you're looking at the market and you had this idea that the market may go long or may be bullish, the first thing we have to do is we have to look at where were the recent highs. And the recent highs happen to be back in February 25th, right here. Let me just expand this here. This price of 2018 quarter, or 2018 quarter, is very important because the market tends to want to test where it's previously been. And so when I think about an opportunity to go long or short, I much rather go long or short going into where the market has previously been as opposed to going to unknown territory. And so this is something that I teach. Hey, Jacqueline. This is something that I teach where whether you're looking at the open method or you're looking at the blueprint method or power price action method, the goal is try to enter into the market with the correct timing. You can be absolutely right. The market may go up, but what if you're late to the move, or what if you're early to the move, or what if you're just hoping that it's eventually going to happen and it never does? So I think timing is very important. And part of price action is understanding price and time. So I really try to keep this as simple as possible. The more indicators and the more different types of charts that you're looking at, the more complicated you make it, I think the more difficult any type of trading happens to be, whether it's the E-mini or currencies or stocks. So one of the things that I tell everyone to add to their chart is this ATR, the average true range. I know some of you here currently have the Atlas Line or are in the mentorship program, and so you know that I talk about this in all the training that I do, having the average true range with a setting of 4 or 5, but I like the setting of 4 because it really does explain to me what's happening. And if the market is slow, I want to understand it. If the market is fast, I want to understand it. If the market is not tradable, I think that unfortunately, I wouldn't want to risk taking a trade if it's too slow or too volatile as well. So there has to be an objective way to understand what's happening on any market and any time frame as well. So if you look here in the ATR, it tells me that the daily chart is about 21 points of activity. And what that means, the bigger picture here, is going to be whether or not the market is going to move up or down 21 points. Giscard, you are correct. So let me update it here to June. Okay. And so the idea here, I had the March contract, so let me just change it to June. And so the idea here is if I expect the market to go up or to go down, what is the perception? The perception is going to be not 50 points or 100 points, but the perception is 21 points that if I take a trade, I can expect the market to move up or down from where it's currently trading, because that's what the last 4 candles average out tell me the market can do. And so at any point in time, whether it's a daily chart for swing trading, which I'm going to show you how to take advantage of it as the market now heads back up, and so on the June chart it would be 2109, 2110. At any time, I want to know whether or not it's worth trading. Okay. Now, with this super year ending in a 5, taking a long position, what I want to do is I want to realize that if the market is going to test the previous highs, because the tendency for the market is to push higher all year long, I don't want to necessarily average in and continue to buy as it goes down. I want to wait until the market makes a clear pullback after making a high. So if you look at where we are here, the February 25th was the highest high in the chart, and then you have here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 candles that are pulling back. Now my criteria is really 4 or 5 bars, a clear indication that the market is pulling back. And the same thing here, if I just go back here a little bit further, you can see that the market made a high, and then we have here 1, 2, 3, 4, 5, 6, 7, a clear indication that the market is pulling back. No, Phil, we're trading to June, right? Rollover is the second Thursday of the expiring contract month, and so when I brought up my charts, it defaulted to March, and so it's supposed to be June. You guys are right. What we're looking at is understanding the market is retracing back at least 4 or 5 candles after making a high, whether it be back here in December or where we are right now as we speak here in March 13th. How do I now take advantage of going long? Because it's not just jumping in and going long hoping it's going to back up. It has to make sense. So you have 2 options here, right? The first option is wait until it comes all the way back and go long 2 points above this high. And that's really telling me that it tested that high and it wants to go higher. That's a great move, and I look forward to taking that long. The same thing happened here, if you guys remember from that webinar I did. As soon as it traded 2 points above the most recent high, no matter how long it takes, actually that's not true, the statistics are 54 days to make that high, or to, I should say, to surpass that high. If you look back on most, if not every single higher high that was broken throughout history, it typically occurs within 54 days. If it doesn't occur within 54 to 55 days, it means the market is not going higher and we're going to go into a bear market. So just something to consider. You know, analysis is very important. You don't have to go overboard with analysis, but statistically, if we're going to make a higher high and this market begins to just flip-flop here around, when it surpasses 54 or 55 days, it's no longer, in my opinion, a reasonable expectation to think the market's now going to break the highs. It's most likely going to flip-flop or it's going to go down more. So that's definitely something you guys need to look at. But I expect the market relatively before 54 days to come up and test that highs and break them. So I recommended to everyone two opportunities to take advantage of this. The first is going to be when it does break this high, go long, and 2 points above it, go long, and ride it up. Now you could say, what's the target, right? So you can say, what's the target? What can I expect? 2 points, what's my stop? All are great questions. Well, I'm going to refer back to the current conditions, which will always lead you in the right direction, always. So if you're looking at understanding what's my opportunity, when this candle closes here, let me just expand this here a little bit. When this candle closes, the average true range updates, and it tells me that about 19.5 points, 20 points is what I can expect the market to move. Now 20 points is a great move. And so 20 points is a great move. So let's take a look to see if the market did in fact go up 20 points. So if I enter right at the close of this day or 2 points above the high, as I recommend, you're looking at about 2100, 2105 for the market to move. And look at exactly where the market went to, 2110, before turning around. If you wanted 50 points or 40 points or 30 points, you may have not received the entire profit target. But if you took advantage of just wanting what the market is telling you that it could do, at this case 19.5 points, if I add 19.5 points to 86, it's going to put me at 206.50. And the market went just above 2106, I should say 2106.50, just above that, and stopped. So this to me is very important because I know exactly what I should take at any given point in time after I enter. Okay? Hey Eric, so if you go back in history and you take a look at every time the market is moving higher and moving higher and moving higher, you can say that it took 3 years for the market to make a new up move, right? But how does that help you, right? You're going to wait 3 years for the market to break the most recent highs that occurred 3 years ago? That doesn't really help me. So if you take a look at after this, I should say, let me go back here. If you take a look at this high, this is the all-time highs that we have here. I would expect if you're going to see the market continue higher in an upward trend, this has to be broken within 54 days. So statistically, that has always been accurate. If it takes more than 54 days, you can then say, I don't think that this market is going higher, at least for right now. It may go down further. It may begin to whipsaw around. But if you're looking for this very specific move on going long with a strong bullish market, 54 days has always been the maximum amount of time it took to make this move. That's for James and Paul. Okay. Now, obviously, hey William, good morning. So obviously, somebody could say for 10 years, the market's going to go up. The market's going to go up. The market's going to go up. But, really, you really can't, just go on for 10 years saying the market's going to go up, keep on buying it as it goes down. And you have to have a time frame where you're saying it's going to go up, where you have the best opportunity to take advantage of it. So therefore, that's where we're looking for. Now, on top of that, I also believe that this may be a little bit late to the party. So we want to enter long because we have a reason, but you're really entering long in the intention and hope that it's not going to give you a double top and that instead it's going to continue higher. So there's another aspect that you guys can take advantage of, guys and gals, which is look at and compare this high and the most recent lows of this pullback, and it's going to start to go up. And when you do that, you have a midpoint, which is right here. Now, once you realize that it went down to 1966, this is the highest high. Once it begins to break the 50% mark, not exactly 50%, but once it starts to break it by 2 points, 2 to 3 points, what you want to see is an immediate push to the upside, which means that from here to here should be instant. You shouldn't see this market begin to flip-flop or turn back around as it did here. It should be an immediate move up. And that was it right there. The same thing happened where this is the all-time highs. The market gave at least 4-5 days pulling back. And then once it starts to creep back up, realize that the opportunity is going to be here, obviously, to go long, but which worked. This actually was a good trade. But why not go long a couple of points above the midpoint and take it up? Because again, the markets test where they've previously been, and they're comfortable trading in that area. So I wouldn't say buy it as it's going down. I would say buy it when you have proof that it's heading back up to test where it's previously been those highs. Both setups are great setups. Obviously, the one here where you're getting in 50%, a couple points above the 50%, is a much safer, as well as you're getting in sooner. It's a better trade, by all means. But not to say that you can't go long once it breaks it, because it is also a very good move. Your target is going to be whatever the average true range happens to be at the time you entered. So right now, I want to give you an exact entry price that you could look forward to. It may happen this coming week, may happen today, it may happen within the end of the month. And the exact entry to go long is going to be at 2070, let's take a look here, 2070, 250, let's say. 2 points above the midpoint. If this never breaks and gets you long and instead goes lower, we adjust it. If it keeps on going lower, we adjust it. When and if, remember, this is a super year, so the bias is long. This is just for a swing trade. It doesn't reflect any type of position, day trading. It's just you hold it for a few days. When it finally breaks, your target is going to be the highs where it's been, or you can take 1 times the ATR. Any questions, guys, on this? No, it's intraday, Hubert. So you don't have to wait for the end of the day to then go long. You can have a stop order if you want right now, stop or stop with limit, waiting to be filled currently at this price here, 72.50, 72.50 on the June contract, okay? That is your limit order. Well, the point is to get an exact number, Maureen. So I'm not using any type of Fibonacci values. I'm using this tool only to give me the 50% of the highest high and lowest low. Instead of eyeballing it, I have an exact price. And so my settings for that would be the 0, the 100, and the 50. And then you right click, manage template, save as default. That's what I do. And I'm no longer interested in any of the Fibonacci values that most people are looking at, just the 50% mark for an exact value. All right, I'm going to switch here to a 5-minute chart because the Atlas line is about to plot here. And I want to show you the order as it happens. Get the data feed here working properly to update it here. 2054 here is the entry to go short on the Atlas line. And the reason why this is happening here at 2054, it's not based off of any indicator that's telling you moving averages are crossing. This is actually very simple. the Atlas line is a tool. A lot of traders actually use the Atlas line in a variety of ways. The way I'm using it is I'm looking for 2 consecutive closings below the Atlas line. And so today's order on the E-mini is a short based off of the closing price of the second candle. 2054 is the entry. If throughout the day the market goes up and closes above the Atlas line by 2 candles, then you have a long. And the long is based off the exact price, which the text is going to display based off the software, is going to be the closing price of the second bar. Sure, Lou, you can put a stop with limit, you can put a stop order, you can definitely use a stop with limit on that swing trade. It's not a problem at all. Maureen, did I answer your question? Just let me know if I missed anything there. If I missed anybody's question, I have a lot of questions here. There's almost 100 of you here in the room, so let me know if I missed anybody. Okay, so I have the Atlas line. This is day trading. This is not swing trading. It works great on a 5-minute chart. I also recommend a 15-minute chart. But on a 15-minute chart, you have larger stops and larger targets. Most traders want smaller stops, and so a 5-minute chart works very well. What's my target? How do I manage this trade? What happens if the trade goes against me? I want to know everything about this trade before I enter, as well as while it's occurring, I want to manage it properly. So I said already that the reason for this entry is that 2 consecutive closes plotted below the Atlas line. The closing price of the second candle, which happens to be this red candle here, is the entry price. So whether you enter at market, whether you enter on a limit, you're entering short 2054 or as close to 2054 as you can. Obviously, I don't recommend chasing it, right? So if you missed it or if you get in 3 points later, that's not the goal here. The goal is to enter as close as possible to 2054 and anticipate it, because the bar timer is a great tool that a lot of traders overlook, right? The bar timer here, because this tells me that the current candle or the candle that I'm waiting to give me this entry has a minute left, 2 minutes left, 3 minutes left. So you are prepared to go short or to get out of a trade based off of the candle closing. So never be caught off guard with any of these orders. You have the bar timer there to help you. And there's lots of free tools on daytradetowin.com. If you go to the software section and free software page that I have, it really does outline the Karen's Time Sync, which you can download for free, which links your computer clock to the world atomic clock, so your computer clock is accurate to the data servers. I think is important. You can download a news indicator, which I think I have here on this computer. Let me take a quick look here. And Day Trade to Win News. So I have coded an actual indicator that plots news on the chart, so I'm never caught off guard with news. I also have for TradeStation, if you're using TradeStation, some of you can also download a bar timer, which I'm not sure why TradeStation platform doesn't offer it, but I have that there. So there's a lot of free tools that Day Trade to Win I have offering for traders. Now you ask, okay, I'm short. What's my expectation? I know that some of you here in the room already know this. If you look at the expectation is 3 points. So never be caught off guard when you say to yourself, what target am I going to take? Whether you're looking at the currencies or E-mini or a 5-minute Atlas line or whatever trading you're doing, you have an expectation. So 2054 minus 3 points is 2051. That is an exact entry and an exact exit. You should never be caught off guard with the orders and your targets. Okay, now I have to say it's not always like this, right? You're going to sometimes the market doesn't do what you want it to do, right? I'd love to tell everyone that the Atlas line will give you 100% winning trades, but it's not true, right? You're going to have to look for a stop strategy if it doesn't go in your favor. So, like bubble wrap, I want to protect myself as best as I can under any situation if the market does not go in my favor. Many traders look at one stop, a hard stop based off of price. But I don't think that realistically you can have one stop that will protect you with every situation that could occur. Because one hard stop basically means that you're waiting for that price to hit your stop. I have a different take on the subject. I believe that if you enter the market at whatever price, right? So this is 2054 on the Atlas line, but it could be a different signal on one of the other methods that you may be trading or that you have of mine. I believe that within a certain amount of time, your target should be reached. If it doesn't reach your target within a certain amount of time, then why should I hold on to the trade? An hour or 2 hours later, it doesn't necessarily mean that the same reason why I went short is still in play. The market's doing something else. It may be reversing. It may be whipsawing or channeling. It may be, continuing to move. So whenever you enter into the market, keep a set time in which you want that target to be achieved. So I know my target is 3 points. I also know that within the next 4 bars after entry, that target has to be reached. If after 4 candles, which equates to about 20 minutes of time on a 5-minute chart, if you're looking at an hourly chart, it would be 4 hours. If you're looking at a daily chart, it's 4 days. If you're looking at half hour, it'd be 2 hours. So it's always relative to the time frame you're looking at. On a 5-minute chart, that 3 points needs to be made within 20 minutes or 4 candles after entry. If it's not made, you're out of the trade, whether it be a small win, a small loss, a break even, almost the winning trade, or almost the 3 points, or almost a huge loss, whatever it happens to be, you've given this trade the opportunity to make it happen. Okay, at the close of the bar, Sally. That's correct. I would say that if the 3 points or whatever signal is taken on the Atlas line or the power price action or the ITO or the all the methods that I teach, I always give it a specific time in which to make it. And the longer you hold on to a losing trade, believe it or not, the worse off you are to see it successfully hit your target. Okay? So limit the amount of time. I always tell everyone, take a break-even trade after 4 candles or take a small profit. You're always better off. Now, let's say that 4 candles are, 20 minutes later, the market is, maybe you're at a loss, right? What do? You click close, or you move your stop, or you move your limit order to get out of the trade. But there are 2 other stops that I think are very important besides the time element. With the Atlas line, there are a total of 4 stops that I teach. They are a time-based stop, and believe it or not, it's not pick your stop, it's whichever happens first. So I always like to look at a stop that tells me I need to get out of this trade because of this reason, whichever reason happens to occur first. So a time-based stop I mentioned was 4 candles after entry. 4 candles here after entry. The prove it stop is based off of proof. Now, proof for me is very important because before you enter long or short, I have proof to go short this market based off the rules of the Atlas line. On that swing trade that I showed you earlier, that I'm waiting for the market to come back up and test the current highs of the year, I need proof, which is 2 points above the midpoint, the 50%, to go long. So proof is very important. I just can't, assume it's going to happen. So the proof here that I'm referring to as a stop is going to be any closing candle closing on the opposite side of the Atlas line. So if you enter short, let me just see here. If you enter short and the market closes, any of the 4 candles close on the opposite side. Hold on a second here. There we go. Closes on the opposite side here of the Atlas line. It's proof that the market's not going lower in your favor. You should get out of the trade. So if you're going to take a loss, take the loss, take the point, take the 2 points. Don't let this go against you for 5, 6, 7 points. You have evidence that the trade is not going to work. Get out. We can always make up that trade later or the next day, but you can't recover from a catastrophe. And in my view, the traders that blow out accounts, maybe the method or the system didn't work. It's totally possible. But if you hold on to a trade for far longer, where you could have had a smaller stop and then now you have to get out because it's 10 points against you out of necessity, that's always going to hurt you more than if you take a small stop and then move on. Okay? I understand nobody wants to be wrong. I don't want to be wrong either when I see these trades. I want to believe they're going to work. But if they're not, take the loss, take the small stop, and move forward with the next trade to recover. So we have the time-based stop, we have the prove-it stop. We also have a catastrophic stop. And the catastrophic stop is, believe it or not, something that a lot of people talk about, and they talk about it as either a good thing or a bad thing. And so when I get a phone call and they ask me, what's your win to loss ratio, or what's your risk? Because those are the things that most traders look at before attempting to trade a method or a system. It's a great question, but with the stops that I offer, it's not as cut and dry as saying it's always a 2-point loss and a 4-point gain, or it's always a 1-point gain and a 1-point loss. We have 3 or 4 stops, all of which offer a different exit. Some stops will give you, for example, the time-based stop will give you maybe a small loss, a small win, or a break-even trade if the trade doesn't work. The prove-it stop will give you a small stop based on closing on the opposite side of the Atlas line. But the catastrophic stop is the stop that needs to be placed as protection. Because if you enter any trade and immediately after you enter there's a catastrophe in the world, or there's a news event that happens in Greece or in Europe, or Janet Yellen, the Fed chair, begins to talk and she says something like, we just decided to raise interest rates, and the market reacts to that. Unbeknownst to you, the market's going to just move. It's going to move really fast, and the time-based stop isn't going to help you. The prove-it stop isn't going to help you, but that catastrophic stop will save you from an unnecessary large loss. So even though the catastrophic stop doesn't get hit quite that often, you need to have it in place to protect you. So the next time you think about placing a stop, it's not a hard stop. It's not, I'm going to risk 2 points and I'm going to make 2 points. You're going to say, if this trade doesn't make my target within the next X amount of candles, with the Atlas line I use 4, then wherever it may be, I'm out of the trade. If I have proof, I'm out of the trade for a smaller loss, and the catastrophic stop is placed as soon as you enter into the market to protect you for an unforeseen event. Let me see here, William. The typical expectancy of the Atlas line, William, when you're looking at taking any of these trades, I want to make the 1 times the ATR. And you can trail. I mean, I teach trailing stops as well, but I'm not really a trailing stop person. I expect 1 times the ATR. That's the expectancy of every single trade. Now, if the trade doesn't work, then I have to get out otherwise. The catastrophic stop probably gets hit once, maybe a month, maybe once a month. All other trades that the Atlas line produces will be either a winning trade, a small winner, a break even, or a small loser based off these other stops. Okay. 2056.12. 2056.12K is the Atlas line. 2056.12. Um, where this pink right here, this little, yes, this is where it's telling you that it's currently plotting. K, if that's your question, or K8, K, hey, I guess it is. Yes, correct, correct, correct. So that's where the Atlas line is plotting, and I'm using price action instead to tell me whether or not to go long or short. Atlas line doesn't just give you these double bar short or double bar long trades. Atlas line as a tool provides a few different trades. So let me show you what the trades are. And I'll go back in history if you guys want to see. Atlas line gives you bounce trades, it gives you pullback trades, and it gives you strength trades. And it has a filter built in based on the market being too slow to be traded. And I actually, those of you who have a lifetime license, anytime there's an update to the Atlas line or I add something to it, you guys get a free update. And so this filter here is based off whenever the market is less than a point on the E-mini. I have here set to 1. You can set it to whatever you want. But whenever the market is trading less than 1 point, it's really not tradable. And so that filter built into the Atlas line will not show a pullback or a strength trade when the market's really untradeable. It's not worth trading. All right, so if you take a look here at these S's that are plotting, right? If you see the S there, S, S, and S, this is telling you that there's a strength trade or a strength trade setup to go short. And strength is based off whether or not you go short if price is trading below the Atlas line, or you go long if price has strength above the Atlas line. So these S's are based on a price action pattern wherever the candles are plotting in relationship to the Atlas line. The pullback trades are exactly the same thing. So let me go back here in history and see if I can show you guys pullback trades. And so this happens to be yesterday. And you see all these S's and P's, S's, P's, S's. This is telling you that you have an opportunity to go long again based on strength. Long again, long again, long again, long again, based on strength or based on a pullback pattern. And so the Atlas line provides these additional trades. But if the pullback or the strength trade doesn't qualify, you won't see them. And I actually teach them. So during the live training, most of you guys already know how this works, but during the live training, I explain to you exactly how and why the pullback and strength trades fire off. Questions? Anyone? All right, did I miss anyone's question? Anyone had any questions that you wanted to ask? Okay, now, one aspect that I want to just bring to everyone's attention, besides the Atlas line trade, besides the idea of going long with the super year, I want to talk a little bit about overbought, oversold, and how that concept plays into us as traders. When you think about the market going long or short, I refer to timing is everything. And typically, when you have a big move that occurs, so a big move up or big move down, many times the indicators that you're looking at, whether it's momentum, MACD, moving averages, they will calculate and say, okay, now it's time to go long or now it's time to go short, right? If you have, for example, two very strong green candles like this, right? Big candles. Could be news, could be anything. And so when you see these two candles, I think the perception is that the market's strong, let me jump in long, because how can I be wrong, right? How can all these indicators be wrong? And you have to look at the bigger picture as far as what just happened. And so what just happened was that in a short amount of time, the market made a very big move. Now, it's not to say that it won't continue, but you're going to find that more often than not, the market doesn't continue after it makes a very fast, strong move, and instead it begins to pull back or range or chop as if it needs to catch its breath, or almost as if maybe traders are taking profit, and so now it stops its move up. And not to say it's not going to move higher later, it's just not the right time to enter long or short after you see something that looks like this. So how can we know whether or not the market is overbought, oversold? Because you may look at that and say, I don't know, could be, or how do you determine that? So we have to all be on the same page. We have to think about how to determine a clear overbought or oversold criteria that will either filter out the trade or say the trade is still good, there's still room for the trade to grow. So the way I do that is by looking at the Atlas line where it's plotting. And what I do is I try to understand that as you're entering as close as possible to the Atlas line to take it down, and you're entering as close as possible to take it up. But in certain situations, you're going to see that two candles that plot above or below the Atlas line, or even crossing. So let's say as the market starts to head back up here, that as soon as it crosses here the Atlas line, that the candle is very strong, and now you have something that maybe resembles this, right? You have two consecutive closings to tell you to go long. The order fires off. It says double bar long at 2070, and you jump in. But before you jump in, take a step back and ask yourself, am I really entering with enough move or enough still push, or is there enough buyers still buying the market in order to take it even higher? Or will this market for the next hour do something like this, flop around like that? And so you really don't know unless you use a very specific model to justify your entry. Take a look at where the Atlas line is plotting. It's currently plotting at 2055.50 because I round down quarter point increments on the E-mini. I round down 2055.50. Then I look at where this signal fired. Did the signal fire far away from the Atlas line, or did it fire closer? Now, if it's close and you can visually see it, it's no big deal. You know it's a good trade. But sometimes it does give you an entry that's higher or lower than what's, I think, acceptable. Look at the average true range. Double this value. Double the value. Whatever it happens to be. So remember, as a trader, you have to be adaptable. You have to adapt, okay? Because the same target, the same stop, under all conditions, doesn't work. By being adaptable, you look at the current conditions and you justify your target and your stops and your filters based off whatever the market happens to be doing at the time. So double the value. So in this case, right now, 3 points is the equivalent of, if I double that times 2, you're looking at 6 points. What that means to me is that if I'm going long or if I'm going short on this double bar signal, which is 2 consecutive closes above or below the Atlas line when it first begins to plot, or when it crosses anytime throughout the day, make sure whatever the value happens to be at that time, it's within 6 points above or 6 points below where the Atlas line is plotting. Or if it's whatever it happens to be at the time, if it's 4 points or if it's 3 points. And the reason why I'm doing that is because before you jump into the trade, you have to make sure that there's still enough push and buyers or sellers to continue, because the last thing you want to be is the guy who goes long when everybody else is taking profit and the market's not going higher. So within 6 points, if there happens to be a trade here, I have to enter long or short, in order to continue the move up or lower. If you enter beyond 6 points, let's say that the entry is here, remember, you still have to see the market go higher beyond where you enter. It may not happen. And so filtering out trades based on very clear and objective overbought and oversold rules, I think is vital, because every signal that pops up, I always put in the trade record on Day Trade 2 when it has recent trades, and it shows you the exact signal. It shows you the target, the profit, and I don't use any major filters. Even if it's maybe overbought or oversold, I still put it there. Unless it's something ridiculous like 10 points above the Atlas line, then I'm not going to put that because nobody would take that. But as a rule, never enter unless you know the market has still room to grow in that same direction. Okay. All right, James, question: does the Atlas line change during the day? No, it doesn't, James. Okay, it stays constant throughout the day. And I actually got an email yesterday from Craig. I'm not sure if Craig's in the room here, and Craig is one of my students, and he said that he plots the. I'll see if I can bring up the email. I'll show it to you guys. That he plots the Atlas line during the London session, and he extends the Atlas line into the day during the U.S. session, and it acts as great support and resistance for him. I'll see if I can share that email with you guys in just a moment. I have to find it. And so I responded back to him. I said, great, I'll take a look at it. And I get emails all the time about how traders are using Atlas line all different ways to help them scalp, for direction, for their own trading, for confirmation, these signals. Glenn, I'm new to this. Does it work on FX pairs too? Okay, so Forex. Forex is not a regulated market, Glenn. I'm not big on Forex, and because you're already entering with a spread, you're already a little bit at a disadvantage. I'm not sure if you know this. I try to, tell everyone that who you're really trading against most of the time is your broker when you place a trade in Forex. You're not trading against another trader. With the U.S. markets, the Chicago Mercantile Exchange, you're trading against another trader, okay? And so I rather trade against another trader instead of trading against my broker who has my entire account information on file and knows exactly what my stop is and can see how I'm managing my trade. So that being said, you're starting off the trade with already a spread. So you're down already when you start. With E-mini, the commission's about $4 now. Maybe a little bit cheaper if you use the NinjaTrader brokerage firm. But you can expect about $4 on average for a round turn, all fees included. Then, besides that, you're using a 5-minute chart. So you're already starting with a negative with a spread, which is sometimes larger than $4. You're using a 5-minute chart, and so the average true range has to be, or the market has to be volatile enough in order for you to make something. And on a 5-minute chart on the Atlas line, I don't think that you have enough of a distance based on what is normal, maybe 5 ticks, 6 ticks, 12 ticks. I don't know if that's enough to compensate for the spread on Forex, Glenn, to answer your question, okay? So I wouldn't recommend, I know traders are using the Atlas line for Forex, but you have to use a larger time frame, like 15 minutes, because on a 15-minute time frame, the target is maybe 6 points or 7 points. It's more than just 3 points, okay? So that's my take on Forex. I think that Forex is a difficult cash market to trade. I would prefer to trade futures and know exactly what I'm getting. There's less shenanigans with futures. Okay. The Maureen, is 15-minute sell valid? 15-minute is good. There's also a pullback trade, Maureen, here. Do you see how this is the P set up for pullback to tell you to go short? So basically, Egon says here, anytime we have a signal, we need to double the ATR value to measure the possible movement as a target and or stop loss. Is that right? Only for the double bar short and double bar long, Egan, not for the pullback or strength trades. because the pullback and strength trades are trades that are continuing. It's only on the initial cross, if it happens to come up, or when it first starts to plot. Sally, the smallest time frame I use for the Atlas line is 5 minutes. I know that you could look at a 1-minute chart. It'll give you great entries, but the target size on a 1-minute chart based off the ATR is small. It's only a couple ticks. So the smallest time frame that I recommend for, a relatively 2 points, 1 point, 3 point, a 5-minute chart catches them all. You can definitely go smaller, but you have more whipsaw under a smaller time frame. And that's why I like a 5-minute chart. And also, the 5-minute here is divisible by most of these defaulted time frames. So the question I get a lot of email, and everyone loves the ABC method, which is free. I have it on the YouTube and on the blog. Or if you've signed in, you can probably watch the ABC and the crude oil, or not the crude oil, the trading the news method, because it makes sense and it works across all markets. And if you think about these time frames working across all markets, most traders are not trading, let's say, a 7 and 45-second chart. Most traders are trading one of these defaulted time frames on every market, whether it be NinjaTrader or any charting platform, Genesis, NinjaTrader, TradeStation, eSignal, MT4. So if you think about an opportunity based on the market breaking out, based on the market hitting support and resistance, it's going to happen. Even news events happen at 8:30 Eastern Standard, 10 o'clock, 2:30 or 12:15, 12:30 for the FOMC. They all happen based off of one of these defaulted time zones. And a move is going to happen. You're going to be able to catch it on a 5-minute, which is divisible by all of these. That's the reason why I like it. It's universal. Ken, do you take a trade just before a news event? I typically prefer not to, because I'm really trading into the unknown, Ken. If you look at a news event coming out, housing, PPI, unemployment, FOMC, what you're seeing is that traders are about to huddle around the news, and then that news is positive or negative, and they hit buy at market or sell at market. And you have an explosion that could potentially make that one candle be a 5 or 10 point move. How am I ever going to be able to trade something that is, I think, unknown, that could potentially be chaotic? So the answer to that question, Ken, is no. Now, as soon as the news is released, and I realize, and you can realize right away within the first minute or two, that there's no reaction to the news. The news was as expected, or the news was within normal parameters. Nobody bought or sold because they thought it was a great opportunity. There was nothing there to buy or sell. Then you can enter. But I don't recommend jumping in, risking the trade, going into an unknown situation. I think that's something that everyone should kind of be very careful with. All right, Ken? Okay, Glenn, good. I'm sorry. The sound's breaking up. I believe you answered my question, but I can't tell for sure. You have to watch the recording. Glenn, what was your question? Just, Glenn, if you do me a favor, Glenn, just type the question again, because there's probably 100 questions here above, and I'll be happy to answer it. Just type it in again, please. Jason, what's your opinion on stocks and price action techniques? I want to clarify that, Jason, just a little bit more. My theory is that price action is much better, and the type of techniques, Jason, just give me an example. Yeah, you can use the P's and S's to trail a stop. Absolutely. So the P's and the S's that you're seeing here are the pullback and strength trades that the Atlas line produces. It's telling me that the market pulled back and it's time to go short again. So these P's and these S's are plotting as an indication to buy or sell again. Sell the market again because it's a short opportunity. The reason being either strength or the reason being the market pullback. Maureen. So the S's and the P's are almost as if they're follow-up trades, because you can take a target 1 times the ATR, and then the market will continue lower and lower and lower, and you say, man, I should have hold it, I should have, taken more profit, and so you don't know at the time, right? It's the coulda, woulda, shoulda idea. So these P's and these S's allow you to take additional trades if the market continues in the same direction. And that's what the P's are and the S's are used for. Days that trend, you're not just taking a one trade on one target, you're taking more trades based on what's happening as a continuation. It doesn't, Nelson, work on MT4 or multi-charts. It works on TradeStation. I get a lot of requests for MT4, and maybe in the future, but for right now, the bulk of the traders are using NinjaTrader. Also, if you would like to try NinjaTrader with live data, email me. I can give you the Get Starting guide, which will allow you to download NinjaTrader, and I can provide you the live data feed as needed, so you can look at live data with the Atlas line or any type of trading. FX, yes, Glenn, I answered the question on Forex. I went on a large rant about Forex having a problem with the spread and using a 5-minute chart. If you're going to trade the Atlas line, you have to use a larger time frame because you're starting already behind at a loss because of the spread, and the targets on a 5-minute chart aren't that large. So you would have to use a 15-minute chart if you do want to trade the Forex pairs. But I do recommend, Glenn, that you look at the futures currencies instead. The 6E is the euro, the 6A is Australian dollar, the 6S is the Swiss franc, because it's regulated. The market moves in tandem, just like the Forex, and I think you have less shenanigans, you could say, with the futures currencies as opposed to the Forex currencies. For the at the open, so the at the open and the, here I'll add the at the open here, at the open. So now you're getting, Jason, into combining the methods, right? Combining the methods that I teach. And so the short setup here for the at the open is 2049 quarter. And the Atlas line is also telling me that price is below the Atlas line, indicating a short bias. So absolutely, if your question is, can you combine the methods? For example, at the open, if you guys have any, I don't offer the at the open anymore by itself. I now offer it in the mentorship program. In 2008, I offered the at the open method. It's a software, and it's a opening range breakout method that works on every market, whether it's the euro or maybe the London Open. And so here is the at the open signal, 2049 quarter to go short, and it worked. If you want to combine it with the Atlas line, realize that they're both indicating short. They're not conflicting. The at the open is telling you short. The Atlas line is giving you short trades. Now, if this at the open signal told you to go short and price was trading above the Atlas line, I would say to you, we have two things that are conflicting. Let's wait until it's clear what's happening. I think that's a great idea, Jason. You got it, Maureen. On the DAX, it should work on the DAX, Phil. Do you have data coming in, and do you have it set up properly? If you email me, I would say the DAX, you have to set it for either the London Open, which is 3 o'clock Eastern Standard, or you have to set it for the US Open, which is 9:30 Eastern Standard. Phil, depending on your time frame, right? So that's more of a support question. Email me, and one of the guys here, Victor or Chad, will be happy to, hop on remotely and take a look. And we do a lot of support for a lot of traders. I think one of the best things about Day Trade to Win is that I have a support staff that helps install the software. They help set you up with NinjaTrader, with live data. They're always doing remote support. So it's almost like you have a good support crew always, well, I wouldn't say always, but available to you, right? If you need help. And some of you here in the room can attest to that, right? You guys are always calling in and saying, hey, can you check to see if I have my settings right? Can you, I just bought the trade scalper. I can't get it to work. Can you help me? And one of my guys goes on and fixes it or helps you right away. So I think that's important when you decide to buy a product that you have support for. Sure, Jason, absolutely. Absolutely. I have no problem with that, Jason. The ability to apply what we learned to these markets, to other markets, if the account fits the ATR, absolutely. You got it, Glenn. It did, Sandy, right? So the 2049 quarter, right? So here's what I teach in the mentorship program. You have an at the open signal. It's an exact entry, 2049 quarter. So again, what I teach is always objective. If you ever enter a trade and the reason in your mind is because it looks like, or it could be, or seems as if it's going to happen, right away there's something wrong because it's not objective. Objective is 2049 quarter. Objective is go long at 2072.50 on the super trade that I showed you earlier. Always use exact prices. My target is 3 points. So those of you who have the At the Open software and have the At the Open course know that 2049 quarter and 2046 quarter, which is 3 points, nice profit, it's a very nice profit, is what you need to achieve. There it was. And you're done. Now, can the market go lower? Sure, it can go lower. Can I expect it to go lower? No. I could only expect 3 points. So there it is. Did it go much lower? Just a little bit, and now it's reversing. That's the reason why looking at the ATR for a very specific target regarding the current conditions is of utmost importance. Sandy. Okay, you got it, Phil. Yeah, just send us a support email. Let me see here. Jason, second question is, the theory can be combined with techniques we learn and then apply them to something like stocks, for example, trading Apple. Oh, okay. So the Atlas line needs 24-hour data, Jason. It does not work on markets that aren't 24 hours. So if you're looking to trade stocks, then the Atlas line doesn't have that 24-hour data in order to complete the calculations needed to plot. But if you're looking at the power price action method, or if you're looking at the trade scalper, or if you're looking at the at the open, then yes, all those methods that I teach are based off of price action. They can be applied to ETFs and stocks and currencies as long as you have enough movement to make it worth your while. I always say on the E-mini, when the market, in any market really, when it's trading less than 4 ticks on a 5-minute chart, it's considered dead or slow or harder to trade. As an example, if you see here pre-market or overnight, and you take a look at this, just as an example, the ATR is less than 4 ticks. How are you ever going to trade this? This is 3 hours of nothing. I don't know about you guys. I live in Florida. At 1 o'clock in the morning, I hear frogs outside and crickets. And that's the last thing I want to do is be up at 3 o'clock in the morning trying to make 2 ticks or a tick under these conditions. So less than 4 ticks, forget it. If it's more than 4 ticks or a point, you have an opportunity. So trade when it's worth your while. Hey, good morning, Greg. All right, guys. I have a lot of Canadian customers, Nelson, a lot. And if you need a NinjaTrader broker, I can find you one. It's not a problem. I have a lot of Canadian people that I work with. All right, Jason. Sounds good. Any questions I missed, guys, before I let everyone go? here to enjoy your day. Hopefully you guys were able to take, not that I really wanted to make this, let's trade 10 contracts and see what happens kind of webinar, but I wanted to show you guys live examples as the market is occurring, how you manage the trades, how you dictate profit, and if anything, you guys have a different perspective on using indicators compared to using price action. Okay, so William asks a question here. So there's a lot of questions here if you guys want to hang on. You guys want to buy the Atlas line? You guys want to buy the power price action? You guys want to get into the mentorship program? It's fine. I do offer discounts for customers. So if you guys are currently a client and want to buy any additional methods, email me. I'll be happy to give you a discount. If you guys want to join the mentorship program starting on the 25th, remember that I do offer credit if you happen to buy anything in the past. I do give you some credit for that, so you don't have to spend extra money unnecessarily. I do provide discounts for our clients if you guys want to continue with your education to learn more. Now this is a pullback trade right here, just so you know. That just happened right now. This is telling you to go short. Okay, William. So as far as different data feeds, let's be honest here, William. The data comes from the exchanges. The exchanges send it to the brokers and to the resellers who rename the data. And whether you are looking at Kinetic or CQG or Rithmic, really the data should be the same because all they do is slap on a different name, right? And if you put lipstick on a pig, it's still a pig, right? As the saying goes. So it's the same data. The difference, though, is filtered or unfiltered. So what they do with that data before they send it to you is important because then they may filter it so you're not getting every single transaction or tick that comes through. So whether you're using Rithmic, which is unfiltered, or CQG, which is unfiltered, or Continuum, make sure that you are clear the data that I'm receiving is unfiltered so I get all of the transactions as opposed to it averaging it, right? So you may have 100 transactions and it'll average it out to 3 or 4, and that's a problem, okay? Because you're just getting a type of average data. Okay, so remember, this is a sell, guys. Pullback trade. William, to answer your question, okay? All right, Sally, sounds good. Greg, Interactive Brokers in Canada are good. No problem with Interactive Brokers. I think they're fine. If you are comfortable with them, if you like them, if they speak your Canadian go for it. As long as you're comfortable with the broker that you and you're able to ask questions. Remember, you're not just a number, you're a name. And a lot of these brokers, because the commissions are so cheap, they treat you like a number. And maybe that's okay, right? If you are considered a number and the commissions are dirt cheap and you're experienced, so what? But I work with a lot of new traders that I think need the assistance. And so the other day, I mean, I get the simplest questions like, what is a stop compared to a limit in a market? What's the difference? And so I asked them, are you trading live, guys? And they say, yeah, we're trading live. And I said, and your broker didn't explain to you, the difference between a stop order, a stop with limit, a market if touched, all of these orders that you can place? And they say no. And that's a problem. Your broker's there to help you and to not so much educate you, but these are the basics that you have to know. So I find myself answering a lot of basic questions, which is fine. I don't have a problem doing it. But your broker should be able to assist you with the basics of trading, Greg. So just think about that when you choose a broker. I have a few brokers listed on my website. I know that not all of them accept Canadian customers because of compliance and regulation, but Interactive Brokers, I have no problem with them. I think they're fine. It'll be available, Rob. Yes, it will. You got it, Armando. You're very welcome. Yes, Greg. It'll be, maybe I'll try it later today. I'll put it on the blog. And maybe I'll send an email out to you guys just to let you know that the recording is available. That way you don't have to keep on checking the blog, or if you want, keep on checking the blog, but it should be available. And if you have any questions, anyone have any questions after you rewatch the presentation, please email me. And, in between my classes and trading and my family, I will definitely answer your questions. And sometimes it takes a day or so to get back to you, but I really try to answer everyone's question myself if it's trader related. And that's why I have the support crew here to take care of the tech stuff. When you have an error message on your NinjaTrader, or you can't open one of the courses because you changed your computer, that's why I have my tech guys to help my clients with that. Oh, good, good. So, what do you think of this pullback trade, Jason? Did it work? Did you take it? Anybody take this pullback here to go short? Now it's a strength trade to go short. I got you, Greg. I understand. Weigh all your options. There's always new brokers coming into the field. They are all hungry for your business. And so just, interview them as well, William. Some brokers do charge for the price ladder, the dome, additionally, but most I think include it, William. It depends on who you work with. All right, Will, you got it. All right, Eric, excellent. Short took 6 trades, very good. 6 ticks. All right, Eric. Giscard, if you're having any issues with the Atlas line or the pricing, do me a favor, email me, Giscard. I'll have one of the guys hop on and make sure that you have the settings correct for the Atlas line. We'll see what's happening with that. Okay, maybe reload your historical data to make sure that there's not a glitch here as well. Sometimes you have a bad data or bad tick. It happens all the time, and by reloading your historical data like this, see here, reload all historical data. Sometimes it fixes or updates, the data. So that's also a possibility. Or open up a new chart or restart NinjaTrader. If you ever think that there's a problem, that usually solves it. Okay, and if anything, send an email. Chad will be happy to help you. Slow and steady, Maureen. I tell everybody there's no reason to rush into trading because you can make mistakes, and losing money on silly mistakes is not going to help your confidence. So I tell everyone I work with, practice. You don't have to jump into getting a broker. I can provide you the NinjaTrader charting platform with live data so you can practice live, taking these trades in simulation, getting comfortable, confident, and consistent. And then when you start, Maureen, go slow, right? Remember I said start off with one contract and just stay. It's not about making money. It's about learning to do this as a career or for the long run. And if you start off with one contract and you lose money, you make money, you're able to recover, you're confident, then you go to 2 contracts. And you stay at 2 contracts until you are comfortable with how it feels to lose, to make it back, to recover, to get ahead, to be consistent, to understand, what it means to make your goal for the day and stop. Because there is psychologically a difference when you see yourself losing, let's say $100 every tick as opposed to $12.50 every tick. Psychologically, you're going to want to exit early. You're going to want to, move your stops and your targets. And so I think that you have to build up to a level of whether it be 3 contracts or 5 contracts or 10, whatever it happens to be, you have to get there. And you can lose or blow out your account whether you have $1 million or $1,000. I mean, it'll work the same way. But you have to, I think, grow into it. And when you rush into trading, you're going to find that you may do great for maybe the first month or first week. But then if the conditions change and you've never encountered these conditions and you start then making mistakes because you never experienced slow markets or fast markets, you're going to be at a disadvantage. So you have to stay within your comfort zone for maybe a month or a week or 2 weeks, just so you can understand this is what I can expect. Now I can increase my number of contracts. Have a great evening, Jason. You too. All right, Justin, good job. roadmap and X5 just in his mentorship because I only teach that in the mentorship. The entry is a closing price 2045, 2046, so the entry price is here, 2045 quarter, the third S, the third P, 2046.75 is the entry. This here is 2045.75, and this here is 2048.50. So the entry price on the strength and pullback trades are the third P for pullback or the third S for strength, Greg. The closing price of the third candle. You're welcome. It does work on eSignal, Carlos. The Dow and the NASDAQ works exactly the same way. Rules are the same. The only thing you have to adjust is whatever the average true range is telling you for that market. It works exactly the same. I would recommend NinjaTrader over TradeStation and eSignal, but I do have it coded for eSignal, Carlos. Dejan, daylight savings time. You know, it's recorded, Dejan. Dejan is in the Netherlands. So please, if you could, review the video and then email me, okay? You got it, Dejan. Okay. Stay safe, guys. Have a great weekend. Hopefully you guys were able to take some of the short trades here. And those of you who signed up for the mentorship program starting on March 25th, I look forward to seeing you guys all in the class. And I will be sending out, those of you who signed up, I will be sending out the first week so you guys can start preparing and testing and looking before the first day of class. I always provide the first week's lesson in advance to get you guys started before we begin. All right? Any questions? Email us or call 888-607-0008. Take care, guys. Bye-bye now.